Now joining us for an interview, Seema Shah, Principal Global Investors Chief Strategist. So Seema, let's just begin where Jamie Dimon and Francine began, with the Federal Reserve, which should have moved sooner, is going to move today. How much room do you see for a hawkish surprise this afternoon?
Hi. In terms of the room for a hawkish surprise, the only way they can do that is that 75 basis point move, which at this stage seems unlikely. But I think the important thing here is, as Jamie said, it's very late. And what's interesting is that, they actually have already started. But if you think, just back in March, when they moved that 25 basis points, since then, actually, it feels like they've even fallen further behind the inflation curve. So the pressure on them keeps growing. We saw the labour market data yesterday, extremely tight. There is considerable pressure for wages to go up. So they have to move very quickly. A 50 basis point move is priced in. A 75 basis point move would probably be better. It's the best way of surprising the market and getting that considerable tightening in financial conditions that they need to bring down inflation. But at this stage, I don't think it's likely.
Seema, how do you value anything right now without knowing where the Fed is going, how quickly it's going to get there, what the terminal rate looks like? If the terminal rate is 3%, then you can value things at X. But if it turns out to be 4% or 5% or 6%, then I have no clue how you value the bond market, the equity market, et cetera, et cetera.
It is very difficult. And I think one of the reasons it's very difficult to read where rates are going is because it feels like the Fed itself also doesn't know. I think that they don't know how comfortable they are with inflation above the 2%. We think that maybe at this stage they're aiming for that 2% inflation target, but actually when they get to 3% and they feel like the economy is starting to slow down, maybe they could be taking their foot off the brake at that stage. And I think that lack of clarity at this moment in time means that, as you said, trying to price out a lot of these traditional asset classes is increasingly difficult.
Okay, Seema, so in this kind of environment, do I want to be in cash? And this is a question we have been asking for a while now, but given the uncertainty, given what Guy is talking about, where how do you value anything, do you just not try?
No, I think that would be the wrong solution at this stage. So, like I said, we don't know exactly how far rates are going to go. But the one thing that we are clear of, which is also what Jamie was saying there, is that the US economy is still very strong at this stage. We are expecting recession, but we don't expect that till early 2024. So that gives us at least 2 years of still positive growth. And that means positive growth means positive earnings growth. So you still can find opportunities. It probably won't be on the index level, so you need to look under the surface, look for the various pockets. But actually, above anything else, I think we need to look beyond the traditional equity fixed income. I think this is a real time for alternatives and specifically real assets, because the key problem facing the economy at this stage is, of course, it's higher inflation. But as long as you have higher inflation and you have positive growth, that is an environment where real assets can outperform. So from our perspective, we are still risk on, but we're displaying that more on the real asset side.
Can you just go into a little bit more detail as to what you mean by that in terms of those real assets? There are different levels of investors. Different levels of investors can access real assets, therefore, in a very different way. If you're a sophisticated institutional investor, you have one option. If you're a retail investor, you have another option. How do you access real assets at this point in the cycle?
Yeah, so the real asset space that we'd be thinking of here would be your commodities, your infrastructure, your natural resources. And obviously from the commodity complex, that's an easy one for almost any investor to get in. I think one of the questions that we are seeing increasingly is, have we already missed the opportunity? Have things moved further on? And our answer to that would be, yes, the geopolitical conflict with Russia, Ukraine, can turn at any time. And there will be a ton of volatility around that. But if you look beyond just the geopolitics and look at the structural shortages of commodities within the market, which has been going on since the COVID recovery started in early 2021, that to us suggests that actually commodities will probably stay elevated for a considerable time. And we're thinking more than just energy. We're thinking, again, as Jane was saying about the wheat, your agricultural goods, fertilizers. So there's so many parts of that market that can continue to perform well. And if you're in the institutional space, well, look, then on the alternatives, then of course private credit is a good opener for you.
Well, Seema, on the point of commodities and energy specifically, we're seeing oil up the better part of 4% today. Brent's at back around $108 a barrel. And of course, that driven in large part by Europe's proposal to phase itself off of Russian oil by the end of this year. What is your view on Europe and the growth picture there, considering we're still talking oil, we're not talking gas?
Yeah, exactly, and I think that's key. It's, the gas, if you were to cut off gas, well, that changes the picture very significantly. But for us, look, the European economic picture is pretty dismal. We can see a slowdown coming through. We are expecting there could be even a recession, even without that cutting gas by the end of this year. So from a fundamental perspective, Europe is not looking like a pretty picture. But then what we have seen as well is that markets have already adjusted their expectations. And a slowdown in growth is increasingly priced in. So if you look at average earnings growth expectations for Europe, they have come down considerably over the last 2 months. So this is now priced in, and valuations are actually looking relatively attractive. So at this stage, fundamentals are looking bad, but the valuations are almost compensating for it. So for our perspective, we're actually neutral European equities rather than underweight.
They are looking attractive relative to what scenario, Seema? And this is where I have a real problem with Europe at the moment. The US has a whole range of outcomes, most of them centered around the Fed. When it comes to Europe, those range of outcomes are largely centered around the war in Ukraine and the response to it. Today, we have seen Europe putting an oil embargo on. If you see a gas embargo put on, I'm assuming that stagflation becomes the central case in that scenario.
Yes, absolutely. And we've seen estimates from the Bundesbank saying a 5% drop in GDP would be likely if there were a cut in gas. So yes, this is not the time to get overweight because you still have that risk weighing over the market. But in our central scenario, we don't see that happening. We're moving slowly, but that is a big, big move for Europe. So at this stage, given valuations, this is a time to be neutral rather than underweight. As you said, the risk of a cut in gas means that we would be very, very wary of pushing into the overweight for European equities.